Adrian Mowat, MD and Chief Equity Strategist for Asia and Emerging Markets at JPMorgan, joins us live from Hong Kong, and he has been one of the biggest bulls on the Indian market. So it would be good to get a sense from him on where we stand now. Adrian, hi, good morning, good to see you in. You know, just about half an hour, or rather 1 hour ago, we were speaking with your namesake, Adrian Lim of Aberdeen Asset Management, and he mentioned that the valuations of the Indian market are not cheap by any standard. So now it should be, just stock picking, quality stocks that you should go ahead and buy and not look at the market top down. Is that your view as well?
No, I think there are some macro factors to look at. We've just had a relatively dovish statement from the Reserve Bank. We think structurally Indian inflation continues to move lower, and that there is a potential for India and countries like Indonesia, where they have high policy rates, to bring down those policy rates, and in quite a meaningful way. So I would regard that as a macro story. I think the other macro story is a bit more fiscal traction, so the government being more successful at spending money in the second half of the year versus the first half of the year.
Okay. Hi, good morning, Adrian. Because of these factors, are you seeing an earnings uptick? What's the kind of earnings growth you are working with, and do you see that getting better?
Well, unfortunately, the trend throughout emerging markets has been earnings downgrades. Now, if we enter into more of an easing cycle in India, then that's probably going to be a story for faster growth in calendar year 2016. And I think that's also true with a bit more fiscal traction. So I think it's looking forward into 16 that's going to be key.
Well, actually, your India economist, Sajid Chinoy, yesterday wrote a note saying that he's not sure there is another rate cut. The broad consensus in the market is, if at all, there is perhaps one more rate cut. So if you didn't get too much by way of monetary easing, would you change your view?
Yeah, I think I would, because, if we keep policy rates where they are, then real rates are going to be high in India, and that will suppress growth. So, yes, if the RBI does not move in the second half of this year, I think that will be a negative for the market.
Okay. So how do you approach it sector-wise, Adrian? Because, your top picks, you have a good mix of a lot of private sector banks. You have some quality technology names like Infosys, names from the auto space. From here on, say for the next 6 to 12 months, how do you structure your portfolio sector-wise?
Well, I think you just told the audience. I mean, that's what our picks are at the moment. I'm not going to tell you the picks are different from what we published. So, let's think about the trends that we're trying to play here. We do expect ongoing investment in infrastructure. There's maybe a little bit more activity happening in the property space. Rural India, which has been under a lot of pressure, particularly with incomes, perhaps get some relief from that. So I think building materials looks interesting. Perhaps even two-wheelers, which have been showing very poor year-on-year increase in sales, in some cases declines, that starts to look a little bit better. Elsewhere, as you highlighted, the auto sector, so more of your consumer play. And we do sort of have a bias towards sort of higher quality financials. We think that's the right sort of way to approach some of the risks in the Indian economy.
Okay. Well, I wanted just one more macro point. I wanted your comment on it. Some people have been making the point that lower crude and lower gold is better in terms of flows into India. As well, domestic flows, when gold doesn't give returns, improves towards financial investments. Is there a liquidity argument that will make you stomach higher valuations?
Yes, look, I think there is, and it's important when we think about valuations to remember what's going on globally. So the world index is on about 17 times forward. India's premium to global equities is actually very narrow at the moment. India is the fastest growing large economy globally. It's got a structural story in terms of a more benign inflation outlook. And there is generally more comfort around the governance, the policy in India. So I do think the market can sustain high valuations.
Okay. As we speak, the mid-cap index has hit a fresh record high, Adrian, and that's been the story of the last couple of days. You know, how many of these quality mid-cap names and even other mid-cap names have rallied. Okay, I think we've... all right. Adrian, did you hear me?
Yeah, you were talking about the mid-cap names.
Yes, I was. Yes, I was. My question is this scorching rally in the mid-cap space a bubble, you think, or is there more to go?
Look, I think we have to be a little bit cautious about this because, you know, as you highlight, it's moved pretty quickly. I think the right thing to do is to be in the larger cap names, some of the names we were talking about earlier, and that's probably a better way to manage your risk than perhaps chasing mid and small caps.
Okay. Are you impressed by some of the reforms in the public sector banks, notably infusion of capital?
It's certainly progress. You know, we would suggest perhaps we're going to need further capital infusion. But, you know, this is good. We need to make progress in this direction. But our preference is really still for the private sector banks.
Okay. Just one question on the flow situation, Adrian, because the inflows that we've gotten into our market lately has largely been retail-driven, you know, retail investors putting money into equity schemes. In fact, there's been about 2,000 crores per month coming into domestic mutual funds. Do you think for the rest of the year it will continue to be driven by domestic money, or do you see at some point a resumption of foreign funds as well?
Yeah, I think if you think about the dynamics here in terms of household savings, so the households seeing lower fixed deposit rates, and as you were already highlighting, the gold prices has been going down. So equities on a relative basis are looking more attractive. So we expect an ongoing inflow into domestic mutual funds. I think in interacting with international investors, we've got emerging market equities. If you look at the broader indices around the 880 level, which is almost at its 5-year low, there's very, very little confidence in emerging markets. I'm finding it difficult to get asset allocators to consider the asset class, particularly this side of a Fed move. So I think for inflows from foreign institutional investors, we're probably going to have to wait until after the Fed has moved. Our base case, it's the 17th of September. And then perhaps once you've got that event behind you, there'll be a greater willingness to buy into EM.
Can you just give us a little more color on the run-up to September 17? Would you expect jitters even in the Indian markets, any serious outflows?
Yes, I think there is risk because what we're seeing is trading volumes are coming down. And so when you look at what investors are focused on, they're focused on the gyrations of the onshore equity markets in Shanghai and Shenzhen in China. They're worried about the implications of the Fed. And so these are all reasons for inactivity. And when you have low trading volumes, then typically volatility can rise.
Okay. But the rupee has been, however, a standout performer in the emerging market basket and maybe even across all currencies. Does that give you a sense that when the dip comes or after that Fed-related dip, India could recover more quickly at all?
Yes, I think the balance of payments story for India is very good, also helped by the fact gold and oil price is low. But remember, when you think about the rupee, you know, it's worth drawing the chart back to 2012. You know, there was a major correction in the currency in the second half of 2013. So you had that reset of competitiveness a few years ago.
You just briefly mentioned that, you know, the confidence in emerging markets as far as equities is concerned has been dipping. As far as we know, you've been one of the most bullish experts on the Indian markets. Have you reduced your enthusiasm on India or your, your allocation to the Indian market? And how much by way of returns do you think India could give by the end of, say, the next 6 to 12 months?
Yeah, so I think with regards to India, if anything, we've become relatively more confidence in the story. So it's tracking the inflation numbers, it's tracking some of the activity indicators, whether those be the industry PMIs, looking at auto sales, looking at truck sales, cement production. So we're seeing a gradual buildup of momentum, lower inflation, and that's making us more confident. Remember, there are other factors at work here, which is the risk of Brazil getting a rating downgrade, entering another year of recession. We've got the gyrations in the Chinese equity markets, a lack of confidence about what's going on in Malaysia. So I think, if anything, our relative confidence in India has been building. But remember, that's a relative confidence against an asset class where some of the fundamentals are deteriorating.
Okay. Well, Adrian, broadly, if you count IT and pharma as defensive, and private sector banks and capital goods and consumer staples as cyclical, in the remaining part of 2015, which way may you tilt incrementally?
Well, we've discussed this earlier. I mean, we've got a bias towards things like building materials, consumer discretionary. Okay. So there is a cyclical bias in the portfolio. That said, on a global basis, and remember, I'm putting together portfolios that are international in nature. I can be overweight Indian IT as well as being overweight cyclical sectors. I do like the IT story in India, and we have had key companies reporting numbers a little bit ahead of expectations.
All right, Adrian, we leave it at that. Thank you for joining us, and we've run out of time, or else we could have continued this discussion longer, but we'll leave that for another day. That's the word coming in from JPMorgan. Relatively, they are more confident on India than ever before. Well, the markets are absolutely flat, so just consolidating after that big run we saw yesterday, but the mid-cap index is doing well. It's up about 0.3%. So that's where all the action is. We will take your leave, and Traders Only will come up and take all the mid-cap action ahead.